I think the main thing that investors are focused on, or what we're taking away from the first 6 weeks or so of the year, is number one, that earnings growth and earnings revision continue to be very solid, especially if you're looking at the quality parts of the market. Number two, despite a slightly softer retail sales number last week, growth in the U.S. continues to be very strong, and I think that's another big driver of earnings growth sentiment and equity sentiment. And number three, there still continues to be a fair amount of cash on the sidelines. Investors want to get invested. They want to move away from the sidelines to not have the same experience that they did in 2023 of missing out on a tremendous year. So I think really all eyes on how growth and inflation sort of move for the remainder of the year. And frankly, the fact that the next move from the Fed, whenever that comes, is a cut, is really reassuring as well.
I'm glad you brought up cash on the sidelines. There was a great piece over the weekend by my Bloomberg News colleagues talking about that $6 trillion wall of cash in money market funds. Actually, if you take a look at just this year alone, 2024, $128 billion have already been added to U.S. money market funds. I mean, what is the firing gun to get that money off the sidelines into the markets? Are we just waiting for the first rate cut here?
You know, a couple of points there, and to your point, yes, above $6 trillion in cash. But one of the pieces of data that I saw that was quite encouraging last week was that it was the first week or the largest week of money moving out of money market funds. We saw that in the EPFR data, which was quite encouraging to me. So I think what investors usually look for when they are looking to sort of invest their cash is a little bit of comfort around the prospect of bonds and stocks. And I think having your money market rates being at a pretty high level has been a source of comfort, but we know that that's not going to last. And at the same time, when you know that economic growth as well as earnings growth are going to continue to be pretty solid, that's a good reason to step out of cash into the quality parts of the equity markets and also to clip some coupon in the bond markets. So I think we're beginning to see that tide turn. And I'll say, Katie, I know we've discussed this on your show before, but you know, when we wrote our year ahead outlook, one of the things that we showed in a chart was how much better pause periods are for bond and stock investors, as opposed to those investors that wait for the rate cut. So if you wait till the Fed goes in June or the Fed cuts in June, I think you've given up some pretty hefty returns, and we can already see that in November, December, January, and so far this year as well.